Welcome back, everyone. Today we have an exciting topic to talk about, which is contra accounts. For many, accounting can be quite the puzzle, but don't worry, we are here to help you put the pieces together and make sense of it all. Let's kick things off with the basics. So, what is a contra account in the first place? Contra accounts are an essential concept in accounting, primarily used to record and represent the true financial state of a business. These accounts are designed to offset the balance in another related account, and in doing so, providing a more accurate picture of the company's financial health. A perfect example of a contra account is called accumulated depreciation. This account reduces the value of a company's asset over time. When a company buys a tangible asset, let's say a delivery van, for example, it initially records this as an asset on the balance sheet. However, as the van ages and its value decreases, the company records a contra account called accumulated depreciation to reflect this decrease in its value. So the van's original cost remains on the balance sheet, but the actual value is reduced by the accumulated depreciation. So let's talk about some common examples of contra account and how these sort of function in different industries. So in the world of finance, allowance for doubtful accounts is a key contra account. This account helps businesses account for potential losses from customers who may not pay their debts. For instance, if a business sells goods or services on credit, it recognizes the full amount as revenue on the income statement. However, it's not always guaranteed that every customer will pay up. I mean, we know this, right? So, to reflect this uncertainty, companies create an account called allowance for doubtful accounts as a contra account to reduce the value of the accounts receivable on the balance sheet. As I mentioned earlier, accumulated depreciation is another classic example. It's used to track the decrease in the value of assets over time, like machinery, buildings, and vehicles. This is important for understanding the true worth of these assets and for tax and financial reporting. In another example, let's take the retail industry, for example. Companies often deal with customer returns and allowances. When a customer returns a product or service at a discount, it affects the company's revenue, right? So we have to accurately represent this somehow. And we use what we call a sales return and allowances contra account to reduce the reported revenue. Now, you might be wondering why contra accounts are so important. Well, they serve several critical functions in accounting. Number one is contra accounts help ensure accurate financial reporting. They allow businesses to report revenue, assets, and other financial elements more precisely. This accuracy is vital for stakeholders such as investors, creditors, and management to make informed decisions. Contra accounts also help in providing transparency, right? So they reveal the adjustments that have been made to the financial statements and make it easier for anyone to understand a company's financial health and the reasons behind it. Finally, contra accounts play a crucial role in taxation. When companies calculate taxes, they need to consider the true value of their assets. Contra accounts help in this process and potentially reduce the tax liability of a business. Now, let's talk about how to record contra accounts on your financial statements. The first step is to identify which account needs a contra account to represent a more accurate financial picture. And this is usually based on accounting standards and specific circumstances of your business. Once you've identified the need for the account, you need to record it in your accounting records. For instance, if you're dealing with accumulated depreciation, you'd debit the accumulated depreciation account and credit the asset's original account. After recording the contra account, you need to update the company's financial statements. So this will reflect the contra account's impact on the balance sheet and the income statement. To truly grasp the significance of contra accounts, let's explore how they're used in real-life scenarios. In the manufacturing industry, where equipment and machinery play a vital role, contra accounts like accumulated depreciation are crucial. They help these companies determine the actual worth of their assets and make informed decisions about when repairs need to be done or when they need to replace their machines or sale. Likewise, retail businesses heavily rely on contra accounts like sales returns and allowances, as I mentioned earlier, because it's the only way to really accurately reflect returns and discounts so that you can maintain transparency in your financial statements and provide a true picture of your revenue. Even in the world of banking, contra accounts come into play. Banks typically create a contra account for potential loan losses, which allows them to better manage their financial health and provide more accurate information to regulators and investors. Like any accounting concept, contra accounts come with their own set of challenges and misconceptions. One common challenge is the complexity of contra accounts, which can be intimidating for those who are new to accounting. However, once you understand their importance, it's really not as scary as it might seem in the beginning, right? And then another challenge is the misuse of contra accounts. If not applied correctly, they can distort financial statements and mislead stakeholders, and therefore, that can lead to a ton of trouble. So it's crucial to use these accounts appropriately. Accounting standards and regulations vary from one region to another, and this can lead to confusion and misapplication of contra accounts, making it essential to stay updated on local accounting processes. All right, guys, let's wrap this up with a few takeaways. Takeaway number 1, contra accounts serve as a balancing act. Contra accounts are like the scales of justice in the accounting world. They help balance the financial statements, ensuring that they accurately reflect the company's financial position. Takeaway number 2, transparency is key. Just like with all of accounting, transparency in financial reporting is crucial. Contra accounts play a significant role in providing this transparency, benefiting both internal and external stakeholders. And last, application is everything, right? It's essential to apply contra accounts correctly. Misusing them can lead to financial misrepresentation and potential legal issues. So always consult with an experienced accountant or financial advisor when it comes to these things. Thank you for joining us again on today's episode of Accounting Recounted. I'm Amanda Hendren, and I hope this episode has helped shed some light on contra accounts and their importance in accounting. If you have any questions or topics that you'd like me to cover in future episodes, please reach out to us on social media or on our website.